Hello, traders. This is Forensic Forex with Deontay, where we analyze the details and specifics of the foreign exchange market. This video is going to focus on the four phases of the Forex market. Before we get into today's lesson, let's talk about our disclaimer. Do your own research. My content is intended to be used for informational purposes only. Please do your research before making any investment or trade based on the information provided and consider your circumstances. You can talk to a professional or do your independent research on verifying any information that you find on my channel. This is a message from myself, Deontay, as I am not a professional. With that being said, let's get into today's lesson. The first phase that the Forex market goes through is consolidation. All markets start in a consolidation. When price moves into a clear trading range and shows no willingness to move significantly higher or lower, this phase is where the market makers are allowing orders to build up on both sides of the market. When I say both sides of the market, in orders, I'm referring to buy orders and sell orders. Now, question, why is this important? So we're going to look on the left side of the chart and we're going to look at exactly what consolidation looks like. So let's take a look. Here is an example of the consolidation phase, which is also known as the holding phase or a holding pattern. Price almost looks as if it's in a spring or being condensed and built up with energy to displace to the upside or the downside. You can see price made a impulse to the downside, and then we got this large candle right here downwards. After this large downward candle, you can see price is ranging back and forth as if it was being held in a tight range, which it is. You can physically see that it's being held within the top of this candle down to the low of this candle and trading within a range. Now, I will say this. Some people may stick to the bodies of the candle and some people may stick to the wicks. That all depends up to you as a trader on how you want to decide on defining your consolidation box. When price moves quickly from a level of equilibrium, this is the expansion phase. When price leaves a level quickly, this indicates a willingness on the part of the market makers to reveal their intended reporting model, whether that may be a buy model or a sell model. Now, a question that we're going to answer later on in the video is going to be, what are we mainly concerned with once we are going into the expansion phase? Now we're going to look at an example on the left of what an expansion phase looks like. Here you are witnessing the expansion phase. So after price is being held in a holding pattern, what we essentially said is a consolidation pattern, which is here on the left in the box, you see that price rallies from this low up to this high, displacing quickly away from an area where price was being held in a tight range. That is the expansion phase. Another phase of the Forex market is the retracement phase, which is when price moves back inside a recently created price range. Price returning inside a recent price range indicates a willingness on the part of the market makers to reprice to levels with higher liquidity focus. Question: when we establish we are in a retracement phase, what are we concerned about? Now on the left, we're going to take a further look and to see what a retracement looks like. As you can see here, we've gone from a consolidation, price trading within a tight range, then an expansion, price leaving that tight range, and now a retracement, price returning to that tight range that it previously formed. That is what a retracement is. When price moves in the opposite direction that the current trend has taken, it is called a reversal. If price reverses direction, it indicates that the market makers have ran a level of stops and liquidity. Price will go above a old high or below a old low and reject and trend the other way. Question: what are we concerned about when a high or low is broken? Now on the left, we're going to take an example and look at what we see as a reversal. Here you can see an example of the reversal phase with New Zealand dollar on the monthly time frame. You can see here March 2020, New Zealand dollar makes a low of the year in March and trends higher throughout 2020. Coming around 2021 in February, price gets above an old high back in 2018 in January and then changes trend and goes lower. This is a reversal. After taking out these old highs, right? There were clean highs here, there were highs here, but price got to this specific high, right? Because there was probably a large order of liquidity or orders here that it wanted to mitigate or trigger to then cause price to change trend. That is what you call a reversal. Now that we've learned all four phases of the market, this brings me to my main concept. Interbank algorithm, which is essentially the price delivery we see as a trader. The price action that we see on our charts are being controlled by the interbank algorithm. Price always starts in a consolidation. Don't let anybody else tell you different. Price will always start in a consolidation. After consolidation, price is only going to do one thing. It is going to expand. It's tired of being in the same place for such a long time. It is accumulating orders, and now it's finally ready to pop in a direction, either up or down. After it expands, there's only two other things that can happen now at this point: a retracement or a reversal. Price can give a retracement and go back into another expansion, essentially, or price can go into a retracement and fail to give another expansion higher or lower, depending on if you're bullish or bearish. Price will then be in a reversal phase, meaning a broken old high or a broken old low, and I was deciding to change trend. It is not trying to expand in its original trend that it started. Now, let's put it all together as one concept. Now, when you tie all four phases in the market together, it's going to look something like this. Now, at the end of each slide of me explaining each phase, I did ask a question, and each of those questions mainly had the general senses of why is this phase important? What are we looking for within each phase? And I'm going to talk about what you should be looking for within each phase. So once we're in consolidation, what we're mainly concerned about is that short-term or intermediate swing away from it. Is it going to expand dynamically to the upside or the downside? Are we going to finally break this tight holding pattern or consolidation pattern to the upside or the downside? Because once we break a side, that is going to show us what model the commercials or the market makers potentially have. Is it a buy model or a sell model? Are they breaking to the upside or are they breaking to the downside? Well, let's see. We're going to press play. Let me slow it down a bit. Pause. We broke the consolidation here at this point, right? We broke this consolidation high, consolidation low. Now, I know people may be asking, well, why did you pick this as your consolidation high and this as your consolidation low? I chose this as my consolidation high because it was the most dynamic candle before price started moving sideways. So I chose this as my designated consolidation high, this as my designated consolidation low because it made a double bottom and then moved up and started trading within this range again, trading around a certain price point again. So this was my high and this was my low. Once price breaks out of this consolidation phase, that's going into what? The expansion phase. What am I concerned about? I am concerned about the equilibrium price point of the consolidation point. So from this high, use my mouse, from this high to this low, and here, yes, I am using the wicks. I cut that range in half, and we get this price point here, right? That is equilibrium. That is going to be a sensitive price point. If price returns here, that may be a buying opportunity. But more specifically, what are we looking for once we leave a consolidation? We're looking for the last down close candle if it's an impulse to the upside. And if it's an impulse to the downside, we're looking for the last up close candle. So here, since it's an impulse to the upside, we have an idea of the market makers or the commercials increasing or buying, going long on New Zealand and going short on the dollar. Weak dollar, strong New Zealand currency, right? The last down close candle near the equilibrium line before the rally is going to be our main focus or price point where we're going to look for a trading opportunity. So we're going to look for the last down close candle, which is this one, before the rally up to the upside, before breaking these highs. Now, you do have these down close candles here, 1, 2, 3, but I'm going to concern myself with the one with the largest body, and this is the largest body closest to equilibrium. It's literally on equilibrium. This, my friend, is a bullish order block. I did not coin this term, ICT did. If you would like to check out his page, it is called the Inner Circle Trader. He has a lot of lovely free content on Forex, and he did coin the term the bullish order block. This candle itself, so I'll just highlight the whole candle's range, is where price should respect, right? We're waiting for price to go into the expansion phase. Now, there are going to be moments where it goes into the expansion phase to the upside. So price is now leaving this low and going up here, right? It may go higher, but it's going up, and it could leave you without an opportunity to get into the market and make money. There are going to be plenty of times like that, especially if you're a new trader. You're going to see all these moves, and you're going to be like, well, why can't I be in this one? Or why can't I be in that one? You can't be in every single play. It's impossible. You got to be in the plays that you see that works well with your personality, with your characteristic, and your time schedule. Everyone has different responsibilities. But as we go through this mentorship program, you're going to understand that there's going to be short-term trading and there's going to be long-term trading. Here, price runs up to the upside, expansion. Now we're waiting for a retracement. And price ultimately goes into the retracement phase and hits what? That last down close candle right here. That's that range that we're looking at, which is on the equilibrium of the consolidation. Price leaves the consolidation and returns back to the consolidation box. We press play. And after that retracement, we're expecting what? Another expansion. So you can see it's a constant cycle and constant flow of the four phases. Now, this could have been a possible area of you going in long with the market and then exiting above a certain high, maybe a high up here, right? So let's say this was the high you were aiming for or targeting. And that could have been a nice trade. You could have brought somewhere down here, have a protective stop loss below the consolidation box or even the order block, and then take profit right above these highs. That's a definitely probable situational trade. Now, after this, if you play it out, you can see price gets above that high and does what? Comes back down again. And what does it test? Equilibrium. Another sensitive price point. But it's still testing what? This 5-minute bullish order block. You press play. Speed up a little bit. Price comes back to this high. And speed up a little more. And does what? After breaking this high, what does price do? What phase does this look like now? A reversal. Absolutely. Look at where what price did. Price came below. I'll just draw this all the way out. The consolidation box down here. That was a reversal. It took an old high out and then dropped lower, changing trend quickly. Now, the phases of the Forex market definitely works differently depending on the time frame you're on. Now, you may be seeing a 5-minute consolidation here, but if you move on to hourly and you look at this, it may just look like one big old candlestick. So the lower time frame definitely is your friend. The higher time frame will be your friend in guiding you in direction and where the long-term trend is. The lower time frame will help you get into those trends and when to get out of those trends. So, with that being said, let's recap. In summary, as a trader, we are waiting for the right condition to seek a trade. However, how does a trader study for that? We use hindsight and demo trading, simply paper trading. Hindsight is 20/20 vision. It is historical context that will help you going forward. The examples that I used today were absolutely hindsight because what occurred is permanently in history. Hindsight creates historical situations. which means we're using prior events and examples to further our analysis on outcomes. In theory, certain conditions we find and see specific patterns occurring, we can follow it and either with some certainty or some degree of probability, keyword probability, can find a trade setup that can grant profitable results. That concludes today's teaching. I'm going to leave you guys off with a quote. I look for a condition and then build a trading approach from that condition. Larry R. Williams. Thank you for your time and peace.